I truly believe that this gold market is different than gold markets that we've seen before. And it's different than what we expect from a gold market. It's being driven by different forces than have driven gold for the last 20 years. So I think it's really important to understand that. I think it helps us understand what might happen next and how it will play out for the stocks, because obviously we've seen the gold price move a lot. Stocks haven't enjoyed quite as much lift, and that's related to the fact that it is different this time. Okay, so for men, and I mean, I'm about to sort of a little bit poke fun at how the West doesn't get it yet, which is a bit ironic because only 6 weeks ago, I was one of the people who didn't get it yet and was still talking about real rates and interest and how these were the things we were watching to see when gold was going to go. But when we look at it, and we've pulled myself and my colleagues have pulled this slide up many times over the last 2 years. We've been like, this relationship is breaking down. The reliable inverse relationship between gold and real interest rates, it broke apart 2 years ago, and that's a very dramatic divergence. And so we all needed to figure out why that was happening. And we came up with lots of explanations. It did happen in a weird time, right? So liquidity and low rates, there was this love affair that isn't just in the last 2 years. This is certainly, it was amplified following COVID, but it started with the great financial crisis when there was all the stimulus and the zero interest rates following the great financial crisis. That's when the markets fell in love with the idea of low rates and the liquidity that it created, and that's made the stock markets go. And it's a very weird, fundamentally, it's a very weird thing because low rates exist when the economy needs support, which shouldn't be when stocks perform. But nonetheless, stocks were performing in these low rate environments because there was so much liquidity floating around everywhere. And that's been the context in which we saw this real rate gold divergence. Okay, so when the divergence started, we had already been saying, okay, well, gold hasn't been performing with low rates for these reasons. Gold stocks don't appeal, or gold doesn't appeal when stocks are doing well, and they've been killing it. Stocks are doing well because of all the extra money, and we're in this weird world where the stock market loves low rates. Okay, so that was the setup. But then rates started to go up in a very rapid way, right? This unprecedented rate hike cycle that we just went through. And gold didn't fall, which we all expected that it would. And so then we needed to come up with more explanations, and we said, okay, well, everybody's aware that this is probably a stock market bubble that's just the Magnificent Seven. So gold is being bought as a hedge because of that risk. Well, they can't just keep raising rates, and everyone knows it because there's too much debt out there. So people are buying gold because they know that this isn't really going to go that high. And you can see from how I'm saying those things that, first of all, those didn't play out. There's still lots of argument out there about whether the Magnificent Seven is part of a bubble, but you know, breadth keeps widening, and they did raise rates really high. And the debt issues, that's another whole talk on its own. But a lot of debt was locked in at very low rates for a very long time, so that it hasn't been that big of a problem. At the end of the day, those arguments, especially like I say, the ones for why gold didn't fall when rates went up, those arguments were weak. They didn't really work. And we missed the boat. We missed the reason why gold was actually going higher, because for so long, gold has always moved higher because of Western buying. For the last 20 years, this chart is not quite 20 years long. I think this only goes back to 2015, actually. I wish it was a bit longer. But when gold has moved higher, it's always been driven by buying in the West. And so that is where everybody looked for what was going on with gold. It's been the thing for so long that that's where everybody looked for answers. But in fact, we missed it because this time is different. In fact, it's China. And I'm calling myself stupid because it took me a long time to figure it out, and it took all of us a long time to figure it out. It's China. I had pulled up this chart a bunch of times saying, okay, well, the reason that gold is staying strong during this rate hike cycle is because of this insane, unprecedented, undisclosed central bank buying. And so we knew that this was happening, but we hadn't really focused in on it. I certainly hadn't focused in on it and said, okay, what exactly is this? Why is this? And is it going to continue? And let's focus on this. And I fault myself for not looking at it more. But the chart had always explained why gold stayed strong during the rate hike cycle, but what explained the chart? Where was all this central bank gold buying coming from? Well, there's a gentleman who's done some really incredible research on gold in China for the last 10 years. And he, about 6 weeks ago, came out and said that he's found sources that we assume are within the People's Bank of China that confirm that 80% of that undisclosed central bank gold purchasing is in fact coming from China. Okay, so when I first read that, I was like, undisclosed sources. I'm such a cynic. I was so skeptical. I was like, am I just supposed to believe you that 2 unnamed sources explain everything that we haven't been able to figure out for 2 years? But then I spent like a long time thinking about it. Yuan is deeply connected in China, so it is very reasonable to think that he would have such sources. Who else is doing this central bank buying? What other central bank or banks out there are doing that much buying? There just aren't any others that could be on the list. It would take a whole bunch of small banks working together to create that volume of buying, but that's a less believable proposition than China suddenly stepped in and started doing all this buying. And it just it makes it all make sense. It says we don't need those weak arguments that we all knew didn't really answer the question. Instead, now we know why gold has diverged from its long-held inverse relationship with real rates, and we understand why gold is moving even though Western investors are not participating in the move. So this time is different, and we finally have figured it out. What's really interesting too, and I think important, is that it's not only the People's Bank of China that is driving this Chinese buying. The Chinese people are also buying because they need a place to store wealth. Now, Chinese retail buying in particular has always been very price sensitive. The Chinese have long bought a lot of gold, but they have always bought when prices are low or falling. They take advantage of that gold price. What's different now is that there is incredible retail Chinese buying, even though prices are high and rising. And that's because of a dramatic change that's unfolding in China, right? China had 20 years of incredible growth. And the fallout from that kind of phase requires a new paradigm of thinking, right? And so retail investors are needing, or just people in China are needing new places, are needing to reevaluate how they're using their money, how they're protecting their wealth. For a long time, it was real estate. Well, that doesn't work anymore. The stock market, that is not working in China anymore. Interest rates, no, that's not giving them any return either. And so, and there's deflation that's eroding their savings. So they needed a different answer. So there's a huge surge of interest from individuals in China also buying gold. This is a really important combination. And we're not talking about a little bit of buying. This is Chinese gold trading on the Shanghai Exchange. Like, this is a dramatic change in the amount of activity, the amount of interest in gold in China. And this is retail, right? This is not the People's Bank of China. That was the previous chart. This is the retail side. Put them together. This is what's moving the gold market. If you want more evidence, you can see it if you watch daily trading. So Chinese buying is apparent in when the price moves. And I'm just using one example, one particular time frame in the last little while. This was the weekend of April 5th, 6th, and 7th. Friday was April 5th. Gold went up during that trading day because that was when there was this rising fear that Iran was going to attack Israel. That was the yellow circle, gold going up. Then that attack did not happen when the Australian markets, also considered Western, right, opened, also considered Western, responding to a geopolitical influence in gold. There was no attack, so they sold gold off. That is the red circle. Then China woke up and started buying, and that's the green circle. And this is one example. One example does not prove a point, but there's lots of examples. If you want to go back on daily trading charts and sort of put together news and timing, you can see this kind of pattern happen over and over again. Chinese buyers taking advantage of the dip and the price moving up when that market opens. Okay, so that's what's happening. The question that really raises is, well, what about the West? The West has always led gold markets higher. They've led it from buying physical, often through ETFs of late, and because that momentum is apparent within the Western investing community, then interest also builds in gold equities, and so they participate. Often they even lead, and so that it all happens together. But that's not really how it's playing out this time because the West is not leading the move. You can see the chart, the double chart on the top shows holdings, gold holdings in ETFs. And so the gold price is in gold appropriately. And ETF holdings continue to decline as the gold price goes higher. That is just clear evidence that it is not Western buying of physical gold that's driving the price higher. Otherwise, those things would be moving up together. The chart below is just the ratio of it, which shows the same story, right? Then the chart on the bottom is the GDX. So the GDX, and it's a long-term chart. These are both, I can't actually see the numbers. These are both long-term charts going back to sort of 2005 or 2008. So it's all crammed together. The latest move is obviously then just at the edge of that chart. The GDX has gained 36% since late February when this gold move happened, which is a 2x on gold's 17% gain. Okay, so that's something for sure. But those of us who spend a lot of time thinking about and watching the gold space realize that a lot of gold stocks have not benefited at all from the move, which isn't too uncommon at the beginning of a gold market. That's kind of okay. But also 3x is really the rule of thumb. If this is a gold market that people are getting amped about, you usually get a 3x leverage from equities versus over the price of gold, and we were only seeing a 2x. So the question is like how and when and how is this going to change? Up to this point, the West still doesn't generally get it. Obviously, there's people out there who do understand, but when you look at mainstream media coverage, I often like to just go to various different mainstream news outlets and click on the gold stories to see what the discourse is. And the talk is all still about the things that have long driven gold. And because those aren't driving gold anymore, the arguments are not very sensible. This is an example, and it's kind of silly to include it, but it's just like such a good example of how they're not getting it. So this is a Bloomberg article, and the argument is gold is correlated to stock market volatility. Stock market volatility has to increase because it's so low. So there's already a question mark there. That's not actually, anyways, mean reversion doesn't include timing. So, and when volatility rises, gold is going to follow, and gold is already gaining because savvy investors are getting ahead of that move. Sorry, what? That's like really a backwards looping argument to try and explain a really dramatic move in the price of gold, a 17% move in the price of gold. So the West doesn't really get it. That's a very common kind of argument that you're still seeing, trying to find rationale for this move where rationale doesn't exist because it is disconnected from the things that have driven gold before. Okay, so the interesting thing, I chide myself for not having understood it earlier. I also took a while to wrap myself, to make myself believe in this gold market, and I had to understand this Chinese force before I did. And I still then was like, well, when and how are the stocks going to move? I'm not sure. What I do know is that the gold chart is very strong. The forces that are driving Chinese buying are not going away anytime soon. They are here to stay. This is from the central bank. This is de-dollarization and deglobalization. Very real forces, and like not sort of the esoteric concepts that they have long been, but now, especially since the invasion of Ukraine and recent events, they're real, they're tangible, right? And then, you know, like I say, resetting the entire Chinese economy after 2 decades of insane growth, these are real forces, and they're very slow moving, and they're going to be here for a while. On the stock side of things, I think what I take heart from is that miners make a lot of money at $2,300 gold, like a lot of money. And if you look at the stock market as a whole, so how are stocks selected these days? Well, there's a lot of passive investing. So you have to start getting momentum before you can before you're part of that. So how do you start getting momentum? Well, hopefully you get picked up by things that are looking for numbers. And what's one of the numbers that the algorithms and whatnot all look for? Profits. You can't just churn out profits as a sector and continue to get ignored. So if gold stays at 2,300 or higher, which I do believe it will, the sector can't be ignored for that longer. The numbers are just too good. So I think that's going to be the thing that starts to bring Western interest here. And once momentum starts to happen, momentum has been the strongest argument to own a stock in North America for a decade now. Momentum has been the thing, has worked the best out of any other rationale for owning a stock. Momentum has been the thing. So yes. Okay. So what do we do about all of this? Like I say, I don't know exactly when stocks are going to start when this Western interest is going to come around. I think that when Q2 results come out, granted that's 3 months from now, but when Q2 results come out and there's been a full quarter of selling gold at $2,300 or better, those numbers are going to stand out. So I do think that that is going to be an important time. And so what do we do to prepare for that? Well, a lot of us are likely already deeply positioned in gold. So one thing is to just stick, right? You've got your holdings. If you want to develop a portfolio that is more specifically primed for this moment, these are the kinds of stocks that I like for this moment in the market. Explorers with a good chance of delivering attention-grabbing results in the next 6 months. And I'm not particularly betting on discoveries right now. The love has not come down to pre-discovery stories, and the risk is always high with discovery stories. But if Western interest in gold equities does rotate in, then companies that already have good discoveries and are like, hey, look, we have a good discovery and we're making it better. Hey, we're making it better again. Those are the kinds of stocks that can really grab attention in that kind of moment. Moving up the food chain, developers. The list of projects of scale and good economics that could be in construction within the next few years, that's just a very short list now. It's been such a grind. There's just not that many stocks that fit that bill anymore. And so I think these stocks will vault higher as the Western interest comes into gold because there's just not that many. And they're the ones that are getting ready to do the golden runway into production or get bought along the way because the majors need more such assets. And then miners. If you want the miners with the best leverage to gold, you look for the ones that have the highest growth profile, another number that sticks out when quants are looking through these things, and the ones that have the lowest costs. And so this is already working well. These are two stocks that I bought in January. They're working really well because of those attributes. I would also just say, make friends with momentum, or don't be scared of momentum. It's really easy, especially for those of us who spend a lot of time in the really junior part of the space. It's really easy to see a stock that's already gained a lot and be like, oh, I've missed that. And with very juniors, a new splashy discovery, that's an absolutely fair response. But when you're in this kind of a market and you're talking about leverage to a growing bull market, don't necessarily be scared of momentum. The stocks that haven't moved yet might still not move for a while. And like I say, momentum stocks have been the best performing category of stocks across the market for a long time. So don't be afraid of momentum. If a stock is doing well, there's a reasonably good chance that it's going to continue to do well because momentum really matters. So that's my take on the markets for the moment. I'm going to end my talk with a bit of an announcement, which is to say thank you so much for all of your time, attention, interest, all of the stock talk, and the community that's gathered around this conference and my newsletter. I've done this for 10 years. It's been an amazing ride. I've loved every moment of it, but I'm actually hanging up my hat as Resource Maven and taking a job with a company. It was just time for change for me. So I am joining West Red Lake Gold Mines. If you would like to hear more about why I'm joining that company, I'll be here and I'd be more than happy to talk to you about that. But Jeff Clark is going to be taking over my subscribers with his Pay Dirt Prospector letter. I think that's going to provide really great continuity of coverage for everyone. And I'm excited for my subscribers to be able to continue getting good advice from him. So that's my announcement. Thank you so much to MIF and to all of you for your attention over the years.